Next up, please welcome my good long-term friend, Harry Dent, global speaker and author. Harry is the best-selling author of books including The Great Boom Ahead and The Roaring 2000s, which I remember well, and holds a Harvard MBA as a Baker Scholar. Join us as he discusses the great bubble burst and then global boom into 2037. So Harry, you have until 5 minutes before the hour where I will cut you off, and then we hand out our next batch of prizes for the day.
Okay.
So you are on.
Thanks, John. Hello, everybody. I'm kind of like a different kind of economist. I wanted to be an economist. I majored in college, and after third course, I just gave up. There was nothing there. They're too vague and conceptual. And so my father's business friends, he was in politics, and he had all these rich donors, and they said, "Oh man, tell your son to take accounting and finance." So I did that, and then I wanted to get in Harvard Business School, and the same guy said, "Well, man, they want, you got to show achievement." So all this stuff, he said, "Well, you took accounting, take the CPA exam." And so I did that and passed it with the highest scores in the Midwest or something like that and all. So I basically went at economist by understanding business. I worked as a consultant in business strategy for Bain and Company of Fortune 100 for about a year and a half after Harvard Business School. And then I just found out, you know what? I don't jive with big companies. They're too big, too slow. I ended up doing the same sort of strategic planning with entrepreneurial businesses in California. And when I got into that, that's when I started seeing the new economy. Now, no longer the old Fortune 100 maturing, but the new economy emerging, especially in California. So I just started studying baby boomers, the new generation, and technologies and technology cycles. And what I found, to be summary, which I found lacking in economics, the economy is a lot more predictable than economists. See, you just have to look in the right places. Consumers are 70% of GDP. And you know what consumers are? They have a life cycle that changes a lot and is very productive at parts. For example, the most important thing they do, they have to enter the workforce, okay, after being born, okay? Well, that's at age 20 on average, 18 for people who come out of high school and 22 out of college, but it averages 20. Okay, that's important to know because up until that, they're an expense to the economy, not just to their parents big time, but the school system and governments and everything. When businesses first hire a real new employee, they have to put in more training. So young people are an investment in the future, an expense, and when they enter the workforce, they start to contribute. And then they buy their first home at 28 on average. Well, that's important because that home is a 5 to 1er, okay? They put down 20% and get 100% of a home, the biggest item they buy. So that's important. And we know when that happens at 28. Now it's not this the housing bubble has changed as the recent time, but this is how it is most of the time. And then they'll trade up to their biggest home while their kids are getting into the best high school so they can get in the best college at 42. But here's the most important thing I found early on in my research. From the Consumer Expenditure Survey at the Bureau of Labor. They spend the most money at age 46. Like, that's the most important number in demographics for the economy. Spend the most. Okay. So all I did from way back in the early 80s is move forward the birth index, which I can adjust for immigrants, which is the hard part. The birth index is easy. And move it forward 46 years, and it'll show you when the economy is going to boom and bust over the rest of our life, most of our lifetime. So that's how simple it can be. But then the life cycle keeps going. They have their midlife, okay, from 47 to retirement. You know what? Then the parents, they don't spend more money. In fact, maybe a little less, but they spend it on themselves, vacation and hobbies and all this sort of stuff. And they may start their own business on the side. I mean, that's when parents get to live their life. And then, of course, there's retirement, and it's not 65. The average retirement is 63. And then people die and disappear. So if we know these things and you get these generation cycles, which the baby boom, that's another thing I got lucky in the time I got into economics, is the baby boom was coming along and they were an outsized generation, larger than most. And so they exaggerated all these things I'm looking at and just made them more obvious, made it easier for me to go give presentations and say, see, here's what these young people are doing, sort of thing. The other thing that's predictable that people don't understand, businesses, it's the new technologies and businesses, they have a life cycle, 4 stages, just like youth, young adult, mature adult, and retirement. They have innovation, radical innovation. Then they have a growth boom when it first enters the mainstream of the economy. And then there's a shakeout stage where you get it down to the leaders who can get far more scale and then bring costs down, and a maturity boom when it goes in the mainstream before it matures and dies. So businesses, technologies, electricity, automobiles, microcomputers now, and now crypto, and AI, they all have life cycles. And if you can see where you are on it, you can know what's coming in the next phase. So again, the economy is more predictable, but it's not. None of this would have, that's why I quit economics. I would have learned none of this in any economic course that I saw in colleges. Okay. Now, the other thing, everything's a play of opposites. My favorite play of opposite is not just boom and bust and inflation and deflation and all these things, and that's all the true, male and female, but simplicity and complexity. Everything is complex, but at the same time, I don't care how complex something is, like our economy and now our global economy, it's also simple at the same time. So you can find the simple trends that most drive, kind of what I call the 80-20 rule, the 20% that drive the 80% of the results. That makes the economy more predictable and understandable to people. And Steve Jobs, he made this quote I love. He says, simplicity versus complexity. He says, that's been one of my mantras, focus and simplicity. Simple can be harder than complex. People don't get that. It's hard to take something complex and figure out what the hell is simple about it. He says you have to work hard to get your thinking clean to make it simple. But it's worthwhile in the end, because once you get there, you can move mountains. So I wasn't trying to do that, but that's how my research, I found things like a 46-year birth lag that literally would predict the major booms and busts out for 5 decades very accurately, which you just would think with all the politics and all the things that can happen. No, if you find the simple driving trend, you can project trends way out for investment and that sort of stuff in business. So again, my contrary view in economics is that the long term is more predictable than the short term. I mean, any economist or forecaster you typically see out there will say, okay, well, we can only really predict so much until the next election and we see how the politics change. I don't even look at that stuff, okay? Bill Clinton had a great boom, and so did Ronald Reagan before him. Republican, Democrat. How much difference does it make? What I found, almost none, okay? And if it does, I can focus on that when it's important. But there's no way. Reagan didn't cause that boom in the 80s. He did some really good things, more than most people. And Bill Clinton walked into the 90s, which my indicators from the beginning in the 80s said would be the greatest decade, the roaring 20s of our time, of our generation, before anybody stepped into office. Bill Clinton walked into the best economy in history. He always says, I never had a great enough crisis to go down as a great president. I'm like, Bill, you're the luckiest president ever. You will always be remembered as a good president, and you were, but the economy, even if you weren't, the economy would have been good. Now, so I'm known more for the demographic cycle, generations entering the workforce age 20, spending the most at 46-year life. In this chart here, that's the middle blue line of these 3 lines, okay? The middle, that's the generation cycle. But since I found a technology cycle, I thought technologies just came when the generation was young and then moved mainstream when they're older. But no, I found it was a different clock. That's a 45-year cycle, as opposed to the generation peaks have come about every 39 years. So that blue line in the middle, peak 1929. 1968, adjusted for inflation in the stock market. 39 years apart. And then again in 2007, before we got into this endless stimulus thing, when the economy was still a real economy, we peaked exactly 39 years after the previous boom on this generation cycle. And then I found there was a geopolitical cycle that was more like, 18 years good and 18 years not favorable. That doesn't affect the fundamental growth, but it does affect people's perception about the world and economy. And so it'll tend to, stock valuations will tend to be higher in a positive geocycle and less favorable in a negative. But that's the least important of these three cycles. And then, of course, there's a cycle that you just couldn't help but ignore since World War II called the decennial cycle I have at the bottom. Of every decade, we tend to get a recession or a slower economy in the first 3 years. And every other decennial cycle, every 20 years, tends to be stronger, like the 2000 to 2022 crash, or the 1980 to 82. And then 2020 to 22 should have been much stronger than it was. But what we had was the biggest stimulus program in history that just rode all over it. In fact, what's happened is you can see 2020 to 22 on the right here. These cycles come together and all down together at rare times like 30 to 33, 1930 to 33, 1973 to 76. That was the worst crash, 72, 73, 74. And then 2020 to 22 should have been more than the minor one-year crash it was. It was significant, but it wasn't a generational crash, but believe me, or particularly a 90-year cycle crash. That should have been the 1929 to 32 or the closest thing to it in our lifetimes and was not. Simple one-year crash, NASDAQ down 38%, S&P down 28%. This was not what should have happened. It was very minor compared to that. Now, my first breakthrough in the mid 80s was the spending wave. That's when I was working with these. I was monitoring these baby boomers, checking out everything about them, their demographics, everything, and I realized, oh my gosh, people's peak in between 45 and 49, and then I was able to do more research and narrow that down to 46. A lot of people copy me and use 45 to 49. That's true. That's where the peak is, but the precise peak is 46 in the U.S. And we're skewed slightly younger because of our high immigration. In Japan and Europe, I find it to be 47. But again, a predictable, precise peak so that we can move forward a birth index in any country in the world, and this includes emerging countries, and see when they're going to grow more and when they're going to decline. And of course, it happens in cycles. And I've got this chart cut off back in 2007. That's before the biggest unending and still unending stimulus program in history. 30 trillion is still going in the US alone. This is a great correlation for a long-term indicator. And of course, the stock market is going to get overvalued and not, so we saw the 2000 bubble and then the crash. And that didn't even hardly cause a recession and didn't stop the boom at all. And then when the 2007 top hit, and believe me, I didn't expect this. I was giving presentations to small business CEOs at Vistage, which used to be called Tech back then, in the mid 80s, saying we're going to have the greatest boom in history and it's going to peak in late 2007 and we're going to go in 2008 will be the beginning of a major downturn. And people say, Harry, you can't predict that far out. It's exactly, it worked out even more exactly than I would have thought. But that's the good thing about demographic. It's set in stone. This is not affected by politics. Of course, politics can affect and other things, but for long term, there's only a few long-term indicators that matter. And that's what I did. I found out technology, generational demographics, and geopolitical cycles. Those three cycles basically peg what's important, most important. And that all of these we can project in the future. And also note in this chart, the blue background. Everybody talks about millennial wave, bigger than generation. Yes, they are a bigger in total numbers than the baby boom generation. Their birth cycle lasted longer, but they're not anywhere near the relative wave, and that's what hits the economy. So the baby boomers were in the baby boomers were like a 10-foot wave hitting the beach. Anybody who surfs know, huge difference between a 10-foot wave and a 3-foot wave, like the Bob Hope generation that came before the baby boom on the left, and the millennials that came. So again, massive number of people, but the relative growth of all the millennials did was bring us back to where the peak baby boomers were. And of course, there's always productivity over time, so it'll be a higher stock market, but it's not going to be the level of a boom that 1983 to 2007 was. And again, what's driving this? This is pure facts, people. I'm not guessing at this. The Bureau of Labor in the US, better than any country in the world, does surveys of 10,000 or something households every year, major samples, exactly what they spend, and they do it down to 600 categories, okay? I can tell you when potato chips peak. When would you guess? I'll tell you, 42. Why 42? Because the average kid is born to the average parent at 28, and the calorie cycle, which is also documented, peaks at age 14. 28 plus 14, 42. Potato chips peak in this cycle. So I can take this down to zip codes if I need to, and individual consumer spending. But for the economy, it's this 46-year lag. And then we kind of had this plateau, which is driven more by affluent consumers that peak later. And then, the demographics turn down. We would have had a major downturn, as this previous slide showed, from 2008 into 2022, 23, if it hadn't have been for this massive, massive stimulus. So here's what happened instead. I call this the markets on crack. You've seen the commercial. Here's your brain on crack. Well, here we have the markets, which I showed. I stopped it at 2008 before on purpose. Here's the markets on crack. Throw in $30 trillion over many years on top of the natural, all the stuff going in the economy, all the money flowing from older people into stocks, and all the spending driving up earnings from the mid-range generation stuff. Look what the economy does when you pour all this extra on it. It just goes nuts. So this would tell me that, when this bubble finally burst, and it is the biggest, longest bubble in history, even in longer term booms, like the early 1900s into 1929, the bubble phase only lasted 5 years, from late 24 into late 29. In the 90s, first tech bubble. That was not from stimulus. The government did not create that. That was a natural bubble, great times, new technologies moving mainstream, baby boom in the prime of their spending growth, right in the middle of their spending wave. And we had a bubble in tech stocks in the early 2000s that crashed 78% with barely a tiny recession, only from the crash. The stock market crash caused that minor recession, okay? So again, the most important trends. And of course, after that crash, I was debating Robert Prechter, who I love long-term as a forecast, but he and I were at odds in Scotland doing a presentation for a big conference there. He was saying the 2000 peak was it. The 2002 crash was the beginning of the Great Depression. I'm like, nope, sorry, folks. Baby boomers aren't done. The largest generation in history spending. There's no way in hell we're going to have a major depression in 1930s economy and that. So that worked out really well for me back then. But again, we're talking simple indicators. But this bubble will burst. I think this is the year that it's most likely to burst, just because they backed off the stimulus partially. They took down the balance sheet, 2.7 trillion, which is nothing to sneeze at. I mean, they brought it up 8 trillion, but they took a third of that back. That's nothing to sneeze at, because the economy's been living off stimulus. This chart says we would have had a long, slow growth period like the 1930s if it hadn't have been for all this stimulus. And again, look at this stimulus. Number one, deficits. Governments spend way more than they take in. That money goes straight in the economy and spending that wouldn't have happened naturally, and makes the economy much stronger. And of course, the stock market loves that. So look at these deficits, 23 trillion over the last 6 years. That, folks, that comes to, all this stimulus comes to about 7% of GDP. So if the government's pouring in 7%, counting the balance sheet, okay, money printing, So if you take those two together, that was about 7% a year on average over the last 16, 17. You pour that on top of normal 2%, 3% real growth adjusted for inflation. We should have had an economy growing 9 to 10%. Okay. But we didn't. But again, stimulus, deficits was the biggest part of it, 2/3 of it, 23 trillion out of actually now it's up to 31 trillion. And the other third was just printing money. The deficits go into the economy directly. The printed money goes directly into the financial markets. Governments are inserting that money, the printed money, by buying bonds, usually treasuries and agency bonds and stuff like that. That money goes into a pool that's chasing the same financial markets and stuff, which means financial markets are going to get overvalued. So the economy is going to grow way faster than it would have, and markets going to have higher valuations. And that's why we have the greatest bubble in history that has not just lasted 5 years in its bubble stage, like every bubble I've seen in history. It's lasted 16 going on 17 years. So if it burst, by definition, we're not going to get a soft landing. Okay. That's all I can tell you. Since it's so manipulated now, it's hard to forecast exactly when and how, but I'm telling you, when this bubble burst, and every single bubble ever in history, anywhere, even back to the Mississippi land and South Seas bubbles, the first bubbles in modern history in 1720 to 22, when bubbles burst, there never, ever has been a soft landing, including 29 to 32, including 1836 to 42. That was the last big 90-year cycle before that. And we're on that 90-year cycle, and it's been pushed off 6 years. You hold back a dam longer, you hold back the water longer, it's only going to be stronger when it hits. That's my view, okay? Nobody's going to agree with me on this, and I don't care. And if I'm wrong, I'm wrong. I'm just telling you, you better at least be wary here. This is the biggest, longest bubble in history, and it will burst, and it will not be a soft landing. They will not be able to stop this dam when it bursts, is what I'm saying. Now, my other breakthrough early in my research, I had studied the Kondratiev wave. It was the one good thing, okay? They came out of economics. Nikolai Kondratiev and Russians, man, Russians. Milutin Milankovitch is the best climate cycle forecaster in all of history. And up until then, Kondratiev was the only guy who had a credible, like 50 to 60-year cycle that went in a spring boom, inflation, which caused a drag, a summer, and a fall boom, which is the bubble boom. Okay, that's when the bubble booms don't come anytime. They come in the fall season when you not only have a boom from, say, like in this case, generational strength and spending, but you also have inflation going down, okay, and getting into near zero. That's the best of all worlds. So that's if you look at the last cycle, the Bob Hope generation drove a boom from 42 to 68. That was a 44-year lag on the birth index because they peaked a little earlier. They didn't have as much college education, okay? But totally generational driven. Summer, the biggest inflation in history. Why the largest generation in history entered the workforce? Much larger than the one back into the early 1900s and ones before, okay? And then the boom that came was the greatest boom in history. I was saying that in the early to mid 80s to all these small businesses. We're going to see the greatest boom in history, and it doesn't matter who's president, okay, or what the politics are past the point, okay. So and those are the bubble booms, and this boom has been a bubble from the beginning. 87 baby bubble, 2000 mama bubble, and now the daddy bubble of all times, boosted with stimulus. And remember, the bubble from late 94 to 2000 did not get boosted by it. They did not print money for that. They did not run massive deficits. This bubble has been 100% artificial in a time when the economy would have been in the winter season in this chart. See this chart? Winter should have come from 2008 into 2022-23. They blew through winter with 31 trillion I just showed in stimulus, and they're still deficits. They stopped the money printing. The deficits are still 2 trillion a year, and we go into a recession ahead. That 2 trillion overnight will turn into $4 trillion on a roughly 30 trillion economy. That is massive deficits. There's going to be a shock if we see that happen. I think people are going to finally wake up. Now, this was a chart I found early on. Great, great chart. I got this out of Robert Perker's book, Conquer the Crash. Wasn't his chart, but it was from people that put this together a long time ago. You see these bubble booms. You see the 1720 bubble. That was a brief bubble back in the time when there wasn't a stock market, but there was two joint companies that were like the first stocks. You know, the Mississippi Land in South Seas in France, and the South Seas bubble in Britain. Those stock bubbled, and it was only rich people buying that. It wasn't everyday people because there was no stock market. But that bubble went up and then it burst 99%, the biggest bubble burst in history. But again, you see a bubble into 1836, okay? 90-year cycle, and then crashes into 1842. That was the biggest crash in history since 1720 to 22. Next big bubble didn't come until, oh yes, the 1929 peak, and then the biggest crash ever in history, 89% in stocks. And then, of course, now we're in a bubble that makes that look like nothing. So again, all I can say to people is this one's harder because governments created this bubble. The 2000 part was natural. This part now into 2026, 100% artificial. They will fight it on the way down. But when you created the bubble and created it so extreme, how are you going to fight it? I say they won't be fast enough when this thing starts to burst. And again, here's a nice long-term channel for these 90-year bubbles, okay? Well, this would say that the S&P 500 would have to go down to about 670. That's a 90% crash just to test the bottom of this channel. Again, they're going to fight it. I say that's the most likely place this ends, and this is why you shouldn't be just sitting in stocks right now. And there's rare times on it. Only 29. Only the 2000 bubble top in tech stock, and only this second tech bubble has hit the top of this channel. Extremely rare topping patterns here. Not a time to be sitting in stocks for the long run. I'm telling you, I'm with most advisors that say, look, just put money systematically in stocks, ride through the downturns and stuff. Yeah, not a bubble burst like this. You can't sit through people who sat through that 29 to 32 crash, 89%, had to wait till 1954 just to get even, and nobody would have waited that long. They'd have sold out on the way down or somewhere. It just wouldn't have happened. But that's how treacherous this is. This is just another, I'm going to skip over this one real quick, but just another, if you look at the 90-year and then the generational 40-year, which is actually 39, and some other cycles, basically, there's times you can see where they cluster. 32 was rare. 42 was a major long-term bottom in stocks. And then late 82 was the next on the generation cycle. And then late 22 should have been one of these major long-term bottoms, but it wasn't allowed to really crash. And again, why does the economy crash? Crashes aren't bad. Recessions aren't bad. Recessions clear out the deadwood after a boom. They do it quickly. They do it efficiently. They do it without bias. They don't care. You just you let the boom happen. You pull out the rug, and who's still standing? That's the survival of the fittest. That's the strong people. No government has to make the decision. The economy lets it become clear. So the economy knows what it's doing. You shouldn't be blocking it. So the next, if I was talking to your kids or grandkids, I'd be saying, you know, when you guys are going to see your next big bubble burst and Great Depression, probably early 2060s. So none of us are going to have to worry about that, but our kids will have to. Again, if you understand the most important cycles, you can see the future over the rest of your lifetimes. You just have to, take out the noise that comes. And we got to get governments to stop intervening in the greatest. And here's my bottom line statement. The greatest invention in all of modern history, and electricity would have been second, okay, is free market capitalism. Came the same time, late 1700s, and democracy. But democracy's there to balance free market capitalism. It's like I call it Harry met Sally. The innovation comes from the free market capitalism, letting things happen, let the economy, raise capital, which it does easily, and let booms happen, and let the economy shake it out. Don't interfere with the golden goose. We unleashed this in the late 1700s, and now we're basically attacking it, okay? So this is a big pet peeve of mine. We're killing the golden goose to prevent a damn little stupid recession. Let's man up and have this recession and get it over because it's going to happen sooner or later, one way or the other. Everybody looks at the national, oh, that's the big thing. They're 38. Now it's already almost 40 trillion. And I'm telling you, with a recession, it'll be 50 trillion so fast you won't even see it at 4 trillion a year. That is not the biggest problem. The biggest problem is the bubble in financial assets that has come from these low interest rates and now all this stimulus and stuff. Look at the past the past boom before this. Look at the narrow range of overvaluation that occurs at the best of the boom in the early to mid 60s, okay? When the generation was spending the most and before inflation set it. Now look how it would take a huge crash just to get back to normal valuations on this sort of chart. So again, this is not a normal time. And I know, and I feel sorry for your financial advisor if you have one. I agree with him most of the time. People shouldn't be trying to time the markets, to extremes because it's too hard. This is not that case. This is a once in a lifetime, a once in 2 generation, once in 90-year crash, and it's actually been put off another 6 years, which just makes it all the more dangerous. And if I look globally at the same thing, financial assets. It's 610% of GDP. So this is a worldwide phenomenon. The U.S. is just the most extreme because we're the strongest on financial assets and on wealth to invest in them. For this just to have go back to normal, normally financial assets are 200 to 300% of GDP. Okay, just to go back to normal, we'd see now basically I've got 250 in there. It'd be $300 trillion of financial assets, stocks, bonds, real estate, everything vanishes and doesn't come back in a new high in the next run. Doesn't come back for maybe 40, 50 years as in the last time, 29 to 68 to 53 actually, just to get back to even, nevertheless to go to new high. So again, this is rare. This is dangerous. And oh yeah, diversify. Okay, I've got all the diversification in here. Real estate, debt, bonds, equities, gold, and cryptos in here. Diversified portfolio goes down 50%. The stocks could go down 90 to 95%. Here's Shanghai, the new kid on the block, the biggest real estate bubble in the world. You think our real estate's overvalued and way more than any time in history? People with 12,000 US equivalent incomes are buying not only one house, but another one or two down the street just for pure speculation, sitting empty because they couldn't rent it out anyway because it's not a rental. If you rent in China, you're a loser, okay? So global real estate, Shanghai, just to go back to the last low. You look at any long-term chart, the Elliott wave patterns and stuff, you've got a third wave peak and then went down to a 4-wave bottom, and then a 5-wave finale, blow off top. Where's that chart going to go? It's going to go back to the 4-wave low. Well, Shanghai, just to go back to the last lows in 2012, 74% decline of people who buy these things more in cash. They don't even get mortgages against them, most of these people. Their whole life savings is in real estate, and it could be wiped out and they could be underwater overnight. I would not want to be the privileged Chinese Communist Party. I'm glad to see they're going to get their ass kicked more than any time in history, but I would not want to be them, and I certainly wouldn't want to be the people in China who've been told to buy homes and developers are told to build them. You know how much real estate's empty? Offices? 22% last time I looked, and it's probably more by then if I could get updated statistics, which aren't so easy over there. China's the ultimate real estate bubble again. Significant percentages of everyday people buying second and third homes. Don't even want to think about what happens in China when this thing bursts. Now, my favorite forecasting model is this. Anybody have any clue what this might be? It's the Masters and Johnson male orgasm cycle. This is my pattern model for bubble. You want to know if you're in a bubble versus an ordinary boom. 1950 to 65, stretching to 68, was an ordinary long-term boom driven by generational and technological cycles, all the things I've talked about. It wasn't a bubble, okay? Bubbles are financial orgasms. They're not black swans. They don't come out of nowhere. They're not irrational. But like orgasms, when they burst, no soft landing because bubbles are so extreme. Again, bubbles are just people get more excited. The peak is the orgasm. And after the orgasm, and you know, us men know, women don't get it, we're dead. I mean, it's over. There's no coming back, okay, unless you're Superman. Again, I've got 20 of these charts, but just here's the classic Dow bubble and burst. No pattern would track this better than this. Or if you find a big pattern, please send it to me, okay? I'll pay you for it, okay? Here's the Nikkei, the other big bubble we have seen in our lifetime. It follows this almost exactly, and there's no soft landing. If the government helped pump this up, you know, which they did, they encouraged all this investing and home buying, would have thought the government could have stopped it. They did not. Because when a bubble bursts, it's like a dam bursting, as I said earlier. Now, here's the female orgasm. Now, this is a little different. Females have multiple orgasms. This is, I guess, the average from Master, and this is from Master and Johnson. This is not made up from their research. 3 orgasms must be the average. Well, I'll take the 3 booms we've had in our lifetime, and now this one that's being stretched. And again, that last part of it, that's the extra 6 years, 100% from stimulus and from no fundamental backing. But here you see 3 bubbles and then a burst that should be very, very extreme. So, real quickly, this is a good slide. You guys are going to get these slides, okay? The 12 principles of bubbles, okay? Let me just run through them quick. This is a good slide to go back and look at. 1, all growth and evolution is exponential and bubbly. I have studied back to the Big Bang when necessary, okay? All growth, if you look at it, is exponential. That's why all long-term charts are logarithmic scale, which is already exponential. And then we get patterns like I showed earlier with these bubbles that are exponential on top of that, exponential with an exponential. All growth is cyclical, not incremental. There's no growth in history that does not go in cycles, and there's larger cycles and smaller. My favorite, which I didn't cover today, is the 500-year cycle by Sheila Hopkins and E.H. Phelps Brown. When I saw that chart, I had an orgasm, you know, okay, as a cycle guy. I mean, massive inflation surges when population and technology is growing the most. We folks are smack in the middle of that 500-year growth cycle from 1900, be precise, the 1897 stock bottom, up until, and that will not peak until about 2140. So we're in the middle of that. So what we're seeing here is stronger than normal growth in a 250-year growth side of a 500-year cycle, and it won't be over. Our kids will see a lot more. Okay, as big as I'm saying this crash will be, there, you know, this whole longer-term cycle is not over. Bubbles always burst. Number 3, no exceptions. If I ever found an exception, I would tell. I haven't found one exception. Okay, the greater the bubble, the greater the burst. Of course. Bubbles tend to go. Now, here's the important part. People say, well, you can't predict. Well, you can see when the bubbles get that kind of orgasm move, which I think we've been in from 2020 to 26. But also, I can project bubbles go back to where the bubble activity, where it diverged from normal growth patterns. And that would be the 2009 low I'd be looking for. You know what 2009 low in stocks from here is? 95% down in the NASDAQ, 90% in the S&P 500. Nobody would think that's possible. Financial bubbles get more extreme over time because there's greater credit and all this sort of stuff, okay? Bubbles become so attractive, they eventually suck in even the skeptic. That's how bubbles end. They don't have to have a fundamental trigger, although they often do, and that's good. Bubbles can get so extreme that which means they've sucked everybody in, and there's just simply no more suckers to get on the bubble, and that's when the Titanic sinks, okay? No one wants the high and easy gains to end, so we go into denial. No, people don't want to listen to me. When I was great boom ahead and all this shit, you know how much criticism I got for predicting a Dow of 10,000 by 2000 in the late 80s? People thought I was nuts. The Dow ended up going to 12,500. People thought that was not even remotely possible, and it went 25% higher than I said, okay? Well, people don't want to see, they're in the bubble, they're high, and they don't want somebody like me telling them this thing's going to crash big time. Major bubbles occur only once in a human lifetime, so nobody around saw the Roaring Twenties and how great it was. And the leading economist there, Irving Fisher, right in 29 said, "We have finally entered a plateau of prosperity." That's what bubbles are like. And that's exactly when it crashed. It didn't see new highs again for 30 years or something like that. Governments have become larger, more powerful. And again, now governments, this is the first, other than the Mississippi Sea and South Seas bubble, I mean, the land and South Seas bubble, which was a government project. They raised money to go and explore the new world. Government promoted that to rich people, okay? But other than that, this is the first time governments have created the bubble instead of just the invisible hand and the Robert Schiller calls it the spirits or whatever. You know, people just getting overexcited. And then finally, bubbles may seem fruitless and destructive when they crash, but bubbles are essential to the process. They come in that growth boom phase that I showed, that four-stage product life cycle, technology cycle. They're part of it. Bubbles raise the money for speculation. They know that nobody's going to know what's going to be the killer app. So they let everybody have a shot at it and then pull out the rug, as I said earlier, and then quickly shake out the losers. The economy's got the best way to do it because people think you can see these things. Yes, you may know we're in an innovative time, but nobody, Ford was not picked to be the winner. I mean, Ford was picked to be the winner early on, and General Motors cruised right by him at light speed, never to be caught up again. So again, this is how things actually work. And then again, real quickly, U.S. home buyers. It's we're in a place where buyers are way below sellers for the first time. So this is when we could see real estate finally start. This is the biggest, longest real estate bubble in history. Okay, way bigger than the 2006 peak. Inflation should be 2%, but stimulus recently pushed it over 9. Then we brought it down. But this is what happened. If they try to stimulate too hard, then they get inflation on the other side. So again, rare convergence. I'm not going to go over this cycle, but this is a convergence into, it should have been in late 2020, the biggest convergence of down cycles in history. All this stimulus, basically for the first time in history, governments decided we're not going to have recessions anymore. And my view is you don't understand the economy simply by stating that, because recessions are as important, if not more. All the great innovation and all the cost cutting and stuff. I used to be a turnaround manager in business, okay, new ventures. All I did was turn around companies. I can make more change and progress in a downturn than in an upturn. Recessions are not the enemy. And then after this, where do we go back? Number one trend. I mentioned a 500-year cycle before. I didn't cover that in depth, but this 500-year cycle, you know what this one's about? The urbanization of the entire world, not just developed countries. We were first and we're already mostly urban. All the developed countries are going to urbanize. And I've done the work in Brazil, China, India, all the big emerging countries at earlier stages stuff. Urbanization, the difference in those countries, and then again, not education, okay? If you just take the average person in a rural area versus the average person in the city, in the urban areas, 3 times the GDP per capita. So urbanization is the most powerful. It's more important than people going from 20 to 46 from their workforce entry to their peak. That's a 2xer, okay? So urbanization is a 3xer. It's the most powerful trend in the world. We are not there yet. It's going to take till about 2085 or later for the whole world to get to 85%, where most countries mature. We're at 82. Japan's extreme because they have no rural areas, and 92%. But basically, this is the big long-term trend, and this trend is nowhere near over. these people all urbanize in the coming decades after this. And then once they're all urban, they'll go through their big spending wave on a 40 some or 50 year, it'll be later by then. And that's what takes us into about 2140. The next 500-year cycle peak will come. Mark my words, because we won't be around. So tell your kids so you'll look smart to them one day. 2140 is going to be the next global peak in inflation and in the greatest standard of living, like's happened every 5 years in the past. And global spending wave. The red line is developed countries. We are maturing between 2007 and 2037. It's not just the US, it's similar in Europe and other countries. It's the emerging countries, the black line, that's going to continue to grow into at least 2100, and probably well past that. So the emerging countries for investors after this crash, we should be looking in the emerging world. You can buy things. You can buy India ETFs and funds, and that'll be the number one country. India is going to be the next China, and EEM is a fund. Real estate here's the difference. Real estate will never be the same because dyers are sellers. Real estate is not like stocks and everything. It lasts forever. So when people die, they are sellers forever. And when I take the peak spenders and to subtract the dyers, then we get a different thing. And again, China, biggest debt bubble in the world. China's spending wave already peaked. Everybody thinks China's going to grow forever. No, they had the one-child policy, remember? They didn't have kids. And now they're telling their people to have 2 or 3 kids. The people are like, no, we'll be poor if we have 2 or 3 kids. We're just getting rich. They're not having kids. China goes down forever. Central banks just keep printing money. Okay, well, that's how we got the bubble. Now they're pulling back. Balance sheet's pulling back for the first time. And I showed you the deficits. Again, simple principle of economics, diminishing returns on debt. The first time you borrow just to buy a house, that's solid. Everybody should do that. The more you borrow, the more marginal returns you get, and the higher the rate of return. So the returns on debt have gone down. This is a bad indicator, and so is the money of velocity. This is my single favorite chart because despite boom or bust, it tells you, are we investing the money productively or not? And this chart says no. Since 1997, right in the middle of the first tech bubble, the same thing back in the early 1900s, the roaring 20s, money velocity was dropping like a rock. It's been dropping like a rock for the last 20 some years. This is a horrible indicator. These things never end well. And China has crashing money velocity as well, and they've more overinvested than anybody. Again, real estate bubbles around the world. Who's the worst? Asia, Hong Kong, Beijing, Shanghai, China, Vancouver. Been to Vancouver and try to buy a condo there? 400 square foot condo for $1 million? Australia, great demographics, but one of the worst real estate bubbles, and then America and so on. So this second bubble in real estate has gone higher, so it'll burst harder. Pending home sales already falling, leading indicator. Mortgage applications have been falling fast. Nobody's paying attention to this stuff. They're just looking at home prices. They're still holding up for now, but probably not for long. And this is like kind of my summary chart. We look at this bubble. Look how big this bubble is now compared to the one in the 80s and 90s and stuff that peaked. And what we have to crash to go down to different levels. I think sooner or later, we're going to get back down to the 2009 low. Any chartist, long-term, looking at these charts and didn't know what it was, would say we're going back to the last big fourth wave bottom in 2009, and that is 90%, again, for the S&P, 95%. Here's India's going to be the next China. We'll worry about that later. But when we come out, I'm going to tell people, start buying India. Don't go back and buy China, even though it's a bargain. China's going to shrink demographically. India is going to be the strongest large country. So the biggest mistake, to summarize here, investors make is assuming that the longer investments boom, the more sound they are. Okay, the smart money sees a difference. They see a market go up too long, and especially start to bubble, they get worried. The more people see it go up longer, they think you can't lose. The second assumption is leading experts will warn them when there is going to be a major crash. And of course, they don't do that. And Irving Fisher, the most famous kind back there, totally missed the 29 to 32 crash. So again, you want to learn from me. Very simple. I've got a free weekly newsletter you can get on to get to know us. I have a paid newsletter and other things and all, but this is a critical time. I am definitely a contrarian voice. A lot of people say I'm a nut, but you need to listen to contrarian people this time. So you can get on our free newsletter very easily. Thanks for being a good audience.